In this video, we're going to discuss what's called cost volume profit analysis. That uses our understanding of cost behaviors to determine the profitability of a business at different levels of activity. Let's suppose we sell a single product and we sell it for $10 a unit. It costs us $6 per unit. So that means that we have a contribution margin per unit of $4. Now we have to sell enough of those units to cover our fixed costs, and that would break even. And then anything above the break even point would be every unit would contribute $4 to profit. So let's determine the break even point. That would be a targeted profit of 0. Well, we would take our fixed cost of $20,000. We would divide that plus a profit of 0, divide that by the $4 per unit. That means that our break-even point would be 5,000 units. If we plug that into a total income calculation, at 5,000 units, our total sales would be 50,000. Our variable cost would be 5,000 times that $6 variable cost per unit. That's 30,000. That gives us a contribution margin of 20,000, and that exactly covers our fixed costs, so that gives us a profit of 0. So down here I've developed a little algebraic development of the formula, but it breaks down to where our fixed cost plus our target profit gives us a total, and divide that by our contribution margin per unit, and that would give us the number of units we would have to sell in order to hit that profit level. So for example, suppose our target profit was $30,000. So I'll plug that in. That means the fixed cost plus that target profit gives us 50,000. 50,000 divided by the $4 a unit is 12,500 units that we have to sell to hit that target profit level. Well, up here I've got it plugged into the income calculation, and you can see that when we sell 12,500 units, that does hit the $30,000 profit. You can also take that fixed cost divided by the target profit, and divided by the contribution margin percentage, and that would give us our sales dollars. In other words, $50,000 divided by the 40% contribution margin would still give us the $125,000 of sales in order to hit that target profit. To think about this just a minute graphically, what we're saying is that if you have fixed costs that stay the same regardless of what your level of activity is. Here we have our x-axis is our volume, and our y-axis is our dollar amount, whether it be dollars of revenues or dollars of cost. Fixed costs stay the same. On top of that, you have variable cost, and so the red line represents our total cost line going up at our variable cost per unit. That would be our slope. The green line represents our revenue line, and the slope of it is our sales price per unit. At 0 units, the revenue is 0, and then it continues to go up at our $10 sales price in that example. So where the revenue line crosses the total cost line, we call that our break-even point. Here's our break-even volume in units, and here would be our break-even dollars, revenue dollars, and total cost dollars, because that's where they're equal. Over here I have a visual representation of a different cost structure, more significant fixed cost, and hopefully if we invest more in, say, automation or whatever, that reduces our variable cost per unit, so that total cost line is going up more slowly. It takes us longer to break even, But once we do break even, hopefully the sales are growing that much faster than the total cost, and so our profits escalate more quickly. So, using our understanding of cost behaviors, we can determine a break-even point. We can determine our profit at different levels of activity, and we can decide, okay, what is our expectation in terms of sales volume to determine whether or not we want to make a certain investment or whatever. So that is called CVP analysis, cost, volume, profit analysis.